That's supposed to be a good market time span. The average Santa Claus rally brings positive results in 75% times, with around 1.3% of return on investment since 1950. Does it mean that if Santa, typically very positive for stock market time, was cancelled, should we expect even worse in the upcoming time when seasonality won't favor stock performance to that extent? Should we brace ourselves for recession? The question that still reverberates in the media. You probably dare to dream of an end to this Federal Reserve's rate hiking cycle as the rest of the world is desperate for it to stop. Even if your initial dream come true, unfortunately, there might be a new bugbear that's almost obvious that it will turn up. Something that hoves into view is quantitative tightening. And alongside, there are plenty other warning signals. Some of them is this labor data that is scaring to some extent, whereas still under control, it may get out at the least expected moment. Thank you very much for tuning in for Blockrevision's episode. Today is the last trading session before Christmas. So I'm very glad you decided to jump on Blockrevision's deck. Let me find out at first whether we are live. So I need you to check. Yes, you can confirm me this in the chat below as it's live if you haven't noticed yet. All right. Without any further ado, let's jump to the first element, and that is intro. All right, and we are at economy view block. What does it mean? It means that we are right now discovering the most, I would say, macroeconomic element of the program. So economy view tells us that there's a kind of a projection that the 60-40 portfolio will be set for comeback in 2023. So if you find out right here, we are right now at the worst year since the global financial crisis. We can find that we are not far from that year, and it means usually that when after it happens, we are more prone to having a positively performed year rather than negatively. So perhaps putting 60% in stocks and 40% in bonds, maybe this time will be much more favorable for many investors that were betting for years for such and a portfolio. So this year is kind of an outlier. This very low underperformance is not the sign that something is breaking right now. It's rather the only one element that sticks from time to time, and you shouldn't bother if you invest in long term. If you investing short term, yes, that might be kind of a painful, but otherwise you shouldn't get totally cyclically destroyed, right? So another summarization of this year shows us that we gone through a very very doomy year for tech stocks. Among the worst performance, Nasdaq 100 was the one that right now I lost the case. So what I meant to tell is that the Nasdaq 100 is the one of the worst performance among recent years. The only one worse was 2002 market bear market downward spiral, and we've seen that we have almost on par with this 18th December. So typically Santa Claus really favors the growth, but this time was almost similar to 18th year. So if yet currently persisting trend to the downside will continue, the sell-off may even ramp up pressure on the few remaining investors with long positions to throw in the towel and also ramp up this this downward avalanche, I would say, even higher. So we have many long positions on the market yet. So it's hard to decide where the market will more likely to go, as put to call ratio still favor bulls. So there are many positions that are hedging against sell-offs. That's why market makers are more willing to fulfill those orders to the upside, where just to make their business to go fine. Scott Minerd. Scott Minerd is the that guy that has been running Guggenheim Partners for years. He was very good at investing in bonds. Unfortunately, he has passed away. So I'm sending my condolences to the family. Recently, the guy was also kind of bringing awareness to all of the crypto investors that this FTX epidemic, as he said, will be spreading even further throughout the industry, and that's what exactly happened. So Scott Minerd was, in many cases, kind of a guy that was visionary in terms of investments, and that point of view was somewhat helpful for many of young generation of investors. So I do hope that recent bond market historical underperformance hasn't ignited that circumstance, and that was just unfortunate turn of event. He was also engaged somewhat in bodybuilding sports, and unfortunately he had a heart attack after recent training, very hard training. So this I would say branch of bodybuilding is also packed with those high testosterone substances that are about to enhance athletic performance, but also, on the other hand, those anabolic agents are potentially associated with negative sequel, including cardiovascular effects. That's why he was kind of a overwhelmed maybe by those type of substances that may been somewhat dire in a consequence for Scott. So best to his family, and best for him. So let's get over to market outlook. What we got in the market outlook is that let me find out to what the index is telling us. For this one, I need you to jump right to a DXY, and DXY right now holding stable, if I could say it like this. We are in a diagonal channel that right now is showing some signs of reversal as we have broken this RSI chart channel to the upside. So it means that this momentum of bear market is steadily decreasing, and we have a chance of a possible reversal at the beginning of January. So we'll be strictly watching this as with DXY, the stock indexes are highly correlated. So DXY is getting more and more interesting. For now, we would expect somewhat much bigger volume, much bigger interest in terms of possible reversal to occur. For now, we don't find any of this. That's why that might be just a fake reaction converged with a recent very low liquidity market. Let's find out what's on SPX. SPX right now is still in a downward trend and with a high probable outcome. I do find that SPX will end up somewhat around 3700s. I will move the window a bit to the right to make it more visible, more clear. So I'm finding this SPX like this. So let's jump back right now. Let's find out what's the performance of this year's assets. The sectors that were outstanding were definitely these energy stocks that where we had this winter season recently very severe. That's why natural gas has risen that far, and also in a longer term, supply continues to be limited and demand is going up. That's why somewhat energy stocks may still be riding this volatility upwards. However, recent price action of oil has shown us that we should, however, get hedged for the slumps, as this oil market is right now in a much more like a downtrend than the uptrend. But this ratio may reverse, as you all know it. Right here at the right, you have a DJI, the Dow, that was the underperformer throughout years during this year, as the inflationary pressure was very high. We have seen that that was the sector that has performed better than SPX and US 100 and became a frontrunner of recent growth in third and fourth quarter. So DJI is at the best performance to S&P 500 since 1933. That's why Warren Buffett might be once again proud of himself, as value stocks has won eventually this year after 2 years of growth stocks outperformance. So also I need you to look at this summarization. I took it from I took it from a Twitter account, Tech Charts, if you want to find out and study it even deeper. So here was a study of breakouts that happened this year, breakouts following recent and follow this depicted marked patterns. So while we were breaking out of the descending triangle, there were occurrence since May of 2017 to December of 2022 of success rate at 63%, whereas a rectangle was 62.9, head and shoulders bottom was 62.3, and so on so forth. However, this year was kind of different. It was much more difficult to trade as market conditions were dictating the type of opportunities that were forming on price charts. And that's what exactly happened, where we had those breakouts very often converging with fake outs. That's why this year was much more difficult to trade. And as an example, ascending triangles that used to give us 56.2% of success rate, this year gave just around 45.5. So this year, regarding to the prior, was colored by this bear ingerence, and that's why those those performance might be somewhat rough. All right, market movers section and what we got out there. I need you to right now jump over to economic calendar, and at first let's have a look at what happened yesterday. So I'm switching over to this week, and on Thursday you may find that on Thursday initial jobless claims was already published. So what we have over there, yes, that was already been studied by us recent episode. Inflation rate in Japan is quite steady. That's why I don't expect very high inflationary or rather hawkish pressure on Bank of Japan BOJ. Today we had personal income that was a bit better than the forecast, and alongside with durable goods orders that was much lower. So goods orders showing us that we are in a market turbulence where these problems may persist for longer. However, the average of durable goods orders showing that we are still nowhere near from the fear. So it's kind of good data that's I would say bearish for the market, as giving us the chance of hiking rates even further. We are still in an environment where a good market, a good economic data is bad for market and in reverse. So we have nothing less than finding out what's the trade idea for today. However, right now, let me know whether the transmission goes fine, whether the chat works, everything is out of issues. For this one, I need you to let me know in the chat below whether it's fine. I will just it is fine. I'm just sending a chat info in order to find out whether everything is okay. All right, so without a much further interruption, we are jumping to trade idea. So for this one, I need you to jump back over to trading view. And what we got out there for today, very interesting chart for me is US 100. US 100 right now shown kind of a huge volatility of recent. And so we can find that this chart is showing a likelihood of going downwards. So we can find that US 100 is more likely to test once again this recent lows of 10,000s, and I do expect this one to happen within days days to deliver. So on a 5-minute chart, we may find out what we got out there. So on a 5-minute chart, we may set the possible entrance, and that will be somewhere around this trading zone, as we have broken the market structure. So any single area around this one is the one to consider possible entrance for the market. At 8:30, what we had out of data, that was durable goods orders, and that was much less optimistic. That's why we had this downward action. But for now, I do expect that US 100 will somewhat revert, and we would have some like this market action. So US 100 is highly likely of going back to 10.6, 10,662 is my objective for this trade. So in order to once again test these lows. So in today's episode, that's it. I wish you Merry Christmas. Just relax from charting just for a while, and we are back on Tuesday, not Monday, but Tuesday, as we still have holidays on Monday. So I wish you very a good time with your family, and all best wishes for you. Thank you very much once again, and see you next.